Dannah Investment Group is our business partner featured here today, and Richard Rogers will be coming on in just a moment. But right now, let's start things off with the CEO of Strategic Source, Doug Austin. Doug, take it away.
Well, welcome everybody. We're glad you're here today. This is a very beneficial program for any businesses that had PEP loans in the past and are looking to acquire the ERC tax refunds. So we thank Richard Rogers today from Dannah Investment for providing this information. As you know, we started this webinar series in May of 2021, and our focus has been to provide innovative suppliers to our audience, which usually consists of clients and sometimes prospects as well. But we focus on expense categories, audit and recovery categories, and then new revenue categories. I think we're up to 35, 36 webinars so far. We've had great participation. We've had encouraging results from this. So I hope you find this helpful and enjoyable today, and you come back again for more. But with that, I'm going to turn it over to Richard. And Richard of Dannah Investments. Richard, take it away.
My name is Richard Rogers. I'm the CEO for Dannah Investment Group. Today, we're going to talk about employee retention credits. There's a number of things that we're going to talk about specifically. Number one, how much employee retention credit do I qualify for? Hopefully by the end of this, you will know exactly how much you as an auto dealer will qualify for, why you qualify for an employee retention credit. Many dealers have been told that they don't qualify. We're going to talk through why you do qualify and how that works, why you need a tax attorney and a team with extensive automotive experience. The auto industry has some very unique opportunities, especially for groups that are over 500 employees. We will talk about that. We're also going to talk a little bit about taxes and how to reduce your tax liability. An employee retention credit is, in fact, taxable income because it's a reduction of your payroll taxes for 2021. So we're going to go through what you need to ask your CPA for in order to manage your AGI and manage your tax liabilities. And then we're going to talk eventually about how to create non-taxable income so that you can manage your tax bracket in the future. My background is that I have spent about 28 years with some of the largest auto groups in the country, including the Penske Auto Group and Galpin Motors. I've had executive positions in those companies. I've also been a equity partner in a 5-store group in Southern California. I've been a professor at a university, currently securities license with 763 and 65, which I'm regulated by the SEC and FINRA. I also have a life, accident, health, property, casualty licenses, and a captive insurance license. I've been working on tax mitigation strategies for approximately the last 5 years, and employee retention credits just happen to be one of the strategies that I focus on. This is our legal disclosure, where this is for informational only. We are not giving tax advice. We're not giving investment advice. And there you have it. So what are employee retention credits? So in 2020, you had a choice of doing a PPP loan or doing a employee retention credit. Most people did a PPP loan, which was the right thing to do. A PPP loan is forgivable debt. It's non-taxable income. And so fairly easy to calculate. The end of 2020, Congress changed their mind and they decided you could do both a PPP loan and an employee retention credit. So the issue is that you cannot get an employee retention credit and take the employee portion of your PPP forgiveness. So you can apply for the PPP loan and an employee retention credit, but you cannot take the employee portion of the PPP loan as forgiveness. The amount of the credit that you can qualify for is basically in 2020 is about $5,000 per employee. And in 2021, it's approximately $7,000 per employee for the first 3 quarters of 2021. The fourth quarter was repealed to help pay for the Infrastructure Act. What we have found is that most employers that took a PPP loan, a PPP-1, basically wipes out the $5,000 you could get for ERC credits. So if you took a PPP-1, that's approximately the amount of the ERC credit you could get for 2020. But you still qualify for $7,000 a quarter, or approximately $21,000 for 2021. So this is a refundable payroll tax credit. This means that you will receive a notice in the mail that says that your payroll taxes have been modified, and that about a week later, you'll actually receive a check in the mail. The check typically includes interest, so it's not exactly what you apply for, but you'll receive a little bit over that, including interest. So what does a typical auto dealer receive? Most auto dealers, as we said, applied for a PPP-1, but not a PPP-2. That's because sales at most auto dealerships increased in 2020 or 2021, despite the fact that most auto dealers had a reduction in new car inventory because of the supply chain shortages. What we have found is that a dealer with approximately 100 employees typically is receiving approximately $2 million back in ERC credits. That's because you qualify for $7,000 a quarter for 2021. And if they took a PPP loan, that offsets the $5,000 taken in 2020. So 100 employees at $21,000 a piece is approximately $2.1 million. Because of part-time employees and turnover, what we have seen is the average is about $2 million. So as we said, the total benefit is calculated, and then it's reduced by the employer portion of the PPP loan forgiveness. So how do you qualify? So we know how much you can qualify for, approximately either $26,000 per employee, or if you took a PPP-1, you will qualify for approximately $20,000. It's $21,000, rounded down, about $20,000 per employee. But there's 2 ways to qualify. One is a revenue loss, and this is what has been pushed the most, if you would. So revenue loss is defined as a decline of 50% of sales in 2020 versus 2019, or a quarterly decline of sales of 20% from 2021 versus the same quarter in 2019. Many dealers did not have a 50% drop in sales from 19 to 20, or a quarterly decline from 19 to 2021. But a revenue loss is one way to qualify. A second way to qualify is a business disruption caused by a governmental mandate. So what is a business disruption? For things like schools, churches, universities, daycares, restaurants, they had an inability to gather. They were unable to meet inside of a building. There was a reduced capacity in many cases. Neither one of those typically apply to the auto dealerships. But almost every dealer in the country had supply chain issues in 2020 and 2021. A supply chain issue is one of the business disruptions, but it's a business disruption caused by a governmental mandate. So what we do is we use our tax attorney that traces your business disruption, your supply chain issue, to the governmental mandate. So they trace that supply chain to the manufacturer, and they trace the local, county, state, and federal mandates that were put into place that created that supply chain issue. That's, in effect, is a cause and effect. The effect is that you had a supply chain issue. The cause is the governmental mandate that was put into place at the manufacturer. So the big question is, what did you have an inventory allocation issue during 2020 and 2021. So what is it that we need to do this type of work? So some of the items that we would need, not including, this is not everything, but most of the items that we would need are employee registers for 2019, 20, and 21, quarterly financial statements for 2019, 20, and 21, because we need to do the calculation to prove that you didn't have a qualification by a reduction in sales. Even though we know that you probably didn't, we still go through the due diligence of quantifying what those numbers are. We need the 941s for 2020 and 2021. And then we need the PPP loan forgiveness applications for PPP1 and PPP2. We also need a list of the owners for each of the entities. And the reason is because any owner that is greater than 51% and any employees related to those owners do not qualify. So we have to back them out. So we have the first poll question. The first poll question is, most auto dealers qualify by either a drop in sales or a governmental mandate. So we've got 67% on a drop in sales and 33% on a governmental mandate. What we have found is that most auto dealers either had a equal amount of sales from 2019 to 2020 or 2021. Their sales may have dropped, but most of them had an increase in sales. Most auto dealers we have found qualify by a governmental mandate because most auto dealers that we have worked with have had supply chain shortages. So there's the poll results. And again, most dealers qualify through that governmental mandate. Okay, so a lot of dealers have been told that they don't qualify. And so the reason that most dealers have been told that they don't qualify is that because they have not had a reduction in sales. A reduction in sales, qualification by a reduction in sales is a calculation that is done. So you can quantify whether or not somebody had a reduction in sales, and if they did, then they qualify. But if you qualify based on a business disruption caused by a governmental mandate, the question becomes, how much evidence is enough to satisfy the requirement? That is work that really needs to be done by a specialty tax attorney, somebody that really focuses on your legal file, focuses on the evidence that you have to determine that, yes, we have enough substantive evidence in order to justify a business disruption caused by a governmental mandate. So that's exactly what they do. They build a legal file that includes tracing the supply chain issue to the local, county, state, and federal mandates. It's not simply a calculation. There's a lot of nuances that can work in your advantage in an auto dealership. If you have a group that has more than 500 employees, well, one of the rules is that you must have less than 500 full-time equivalents. Well, you don't have to count hours worked for employees that are not working, if you would. So we can actually whittle that down a little bit by looking at the hours that salespeople actually spend selling a car. We can look at the hours that a technician is actually working on repairing vehicles and not the time that they're waiting for that next stop. So there's some things that we can do specifically to help with those numbers. Another thing that at least you should be aware of is the IRS specifically lists an auto dealership as one of the examples in their FAQs. So if you have more than 500 employees, do you qualify? One of the rules state you need to have less than 500 full-time equivalents. As we said, there are some special rules that work in your favor. There's several things that work in your favor. Number one, salespeople. Salespeople are not, they're paid to sell vehicles. So the money that you pay them is specifically used to sell that vehicle. The couple things that we can do that are very unique to auto dealers to help them get under that 500 threshold. One of the big things that make the employee retention credit different than the PPP loan is that it's taxable income for 2021. So it's not actually income. This is a reduction of your payroll tax expense, which creates income. This means that your CPA will need to amend your 2021 corporate and personal tax returns. One of the strategies, and David, do we have a poll question there? No?
Not yet. It's coming up.
Okay, great. One of the strategies that we have used for our clients is that you can take, if you're concerned about paying the taxes on the employee retention credit that will be due, is that you can take the employee retention credit and put that full amount into an investment account. And then you can open up what's called a securities-backed line of credit. Currently, the rate on those securities-backed lines of credit are about 3.5%. The money can be invested at a larger amount. So we can use a target rate of say 6 to 8%. You then earn the arbitrage on what you would have otherwise paid in taxes. One of the strategies that can be used, we're actually going to dig into detail a little bit on that strategy and quantify exactly how much more money you can make by using that. Now we have the poll question. So once I receive my credit, my refund, will I need to amend my corporate return, or will I need to amend my personal and corporate returns? All right, so let's share the results here. So we've got 60% that says amend my corporate return and 40% that says amend my corporate and personal return. So this is a little bit of a trick question that it depends on whether your corporate return is a pass-through entity. Is it a S Corp or an LLC, or am I set up as a C Corp? If you are an S Corp or an LLC, you will need to amend your corporate and personal tax returns. If you're a C Corp, then you will not. So in effect, I think both the answers are correct, and we will move on. We talked about how do I pay the taxes due using a securities-backed line of credit. So if we assume that my employee retention credit is $2 million, and I take that $2 million and I invest that and I put that into an account that earns at about 8% per year. We have bonds that will earn approximately 8% per year. And then I pay my tax at the highest tax bracket we can imagine at 50% federal and state. If I pay my tax at 50%, which is $1 million on $2 million, out of my securities-backed line of credit, and we're not going to use 3.5, we'll use 4% to round up, I'm going to pay approximately $40,000 on $1 million per year. So my net cash earned that year is $120,000, which is the $160,000 minus the $40,000. If I allow the earnings in my investment account to add up to pay for my line of credit, it will be paid off in approximately 8 years. At the bottom, if I just take the $1 million and I pay down my tax bill and I let that earn out at, every year and compound that, I'm going to make $254,000 more by investing that money and using the bank's money on a securities-backed line of credit to pay my tax. The bottom line here is you're always better off to invest money at a higher rate and then use a lower rate if you can to invest it so you always have the money working for you. So we're going to talk about 2 tax strategies that can be used to reduce your AGI. This is taxable income for 2021, but you're going to have to pay estimated tax payments on last year's income. There are 2 things that can be done. Again, this is just an example. Everyone's tax situation is unique, but again, we're going to assume a $2 million AGI with a 50% applicable tax rate. So that would be $2 million minus 50% is $1 million of tax due. The first strategy is called the pay the tax strategy. I've actually sat with tax attorneys that have said they always recommend that their client pay the tax. And then so for me, that's really not a strategy. It's the most conservative approach. You know how much you're going to pay, but there are other things that you can do. One is charitable strategies. So charitable strategies in general, contributions to charitable organizations may be deducted up to 50% of adjusted gross income, computed without regard to net operating loss carrybacks, which means that on $2 million, I can give $1 million away. But if I give $1 million away, I actually am not going to receive that full benefit. Because if I spend $1 million in cash and I get a 50% tax benefit on that, my true benefit is $500,000. But we have strategies that allow us to take and multiply that number. And on $100,000 of charitable giving, if you would, we're able to get a $500,000 tax deduction. How that mechanics of that works is beyond the scope of this webinar. My point is that there are charitable strategies that can multiply the benefit and the tax benefit of that strategy. Second strategy is there's an oil crisis in the United States. Oil prices have come down a little bit over the last couple of months, but the bottom line is that oil prices are very, very high. I know a lot of people complain about oil prices. This is back in a couple of months ago where oil on 6/24 was at $113 a barrel. It's gone up. Depending on who you talk to, some believe that oil will stay above $100 a barrel. The sources we talk to tell us that they believe they're going to be somewhere in that $80 to $90 per barrel range. But that's good news for you. And the bottom line is, why is that good news for you? Because the oil companies are making money. They're making quite a bit of money. If we look on the right, we see oil prices have gone up dramatically from 2019 to 2022. On the left, we've got profits of 4 large oil companies. You can see that ExxonMobil had a huge drop in October of 2020. That was a one-time charge. But for the bottom line, most of them are up dramatically. So why is that good news for you? Well, if you're able to get on the side of the oil company and make money with the oil company, then that's going to be good news for you. There are some special rules related to intangible drilling costs. So intangible drilling costs are expenses related to developing an oil or gas well that are not part of the final operating well. Their costs are necessary in drilling and preparing of wells for the production of oil and gas, such as survey work, ground clearing, drainage, etc. The bottom line is that money invested in IDCs or in intangible drilling costs are deductible at approximately 92%. So $100,000 invested in a drilling cost, a drilling fund, is 92% tax deductible. The question becomes, which one do you use? We work with one of the largest privately held drilling companies in the U.S. They partner with very, very large oil companies, all of which you know their names because that's who we buy gas from all the time, every week. So if we use that strategy and we use our taxable strategy on that same $2 million, if I can reduce my AGI by 50% and I can reduce my IDC strategy, I mean my intangible drilling cost strategy, at $800,000, I reduce my taxable income down to $200,000 at the same 50% tax bracket, which will be less because it's a lower tax bracket. I end up with a net cash outlay of $350,000. The cost of the charitable strategy is $250,000, which gives me a $1 million tax deduction. To pay the tax strategy is going to end up costing $1 million with doing no tax planning. The net cash savings by using these two strategies is approximately $650,000. So the bottom line to both of these strategies is that you need to know what your AGI is for the year. You need to know what your tax liability is for the year so that you can plan in advance on how to minimize that. What we recommend many times with that savings is to create tax-free income. This is just one example. A 58-year-old male paying $58,000 a year for 5 years can generate $83,000 in tax-free income for 25 years starting at age 65. That's a total of $1.1 million in total living benefits. Our example of using those two strategies generated $650,000 in tax savings. So if we use that $650,000 in tax savings and we pay $585 for 5 years, we'll generate $830,000 in tax-free income for 25 years, starting at age 65. That's a total of $11 million in total benefits over that 25-year period. So in order to put any of those things into play, you need to know what your AGI is. You need to know what your taxable income is. Your ERC credit is a piece of that calculation, but there's a couple other things that you need to ask your CPA for. Number one, what is my estimated AGI for 2022, for this year? That's going to involve a forecast on your company, but it's important to know what that is because in order to implement the best tax strategies, you need to be able to plan in advance. Number two, do I have any capital gains from K1s from 2021? Why is that important? Because if you have a capital gain from 2021 on a K1, you can actually defer that until 2026 up until September 11th. After September 11th, it's too late. But if you have capital gains from last year, they can be deferred to 2026. If you have any capital gains in the last 150 days, that's important to know because any capital gains in the last 180 days, you can defer until 2026. Again, what is my deferred tax waterfall? What does that mean? That means that if I have taxes from the past, tax expenses that are going to be incurred in the future, it's important to know what years those are going to be, when those are going to be due. So it's important to know what that schedule is. What is my deferred tax waterfall? Do I have any net operating loss carryforwards? If you have net operating loss carryforwards from the previous year, it's going to offset your AGI. So that's going to be taxes that you don't have to worry about for this year. And again, if you're planning on selling your business, what strategies are being to reduce, defer, or eliminate capital gains? If you're in the process of selling your business, you're able to defer all of the capital gains using the right strategy. We have a number of strategies that we use in order to do that. But this is a little checklist that every business owner should be asking their CPA for. You know, what is my AGI for this year? What are my capital gains from K1s? Do you have any capital gains in the last 150 days? What's my deferred tax waterfall? Do I have any NOL carryforwards? And then if you plan on selling your business, what's the strategy that's put into place? If it does not involve deferring or eliminating your capital gains, then you just need to be aware to ask the question. One of my favorite sayings that I have been told is that paying taxes is a moral and legal responsibility. How much and when you pay it is a personal choice. So what do we offer? So we offer a free consultation on employee retention credits. On the phone, we will tell you exactly what we think you'll actually receive. We have a consultation on reducing your tax liabilities. We have consultations on deferring capital gains. We have a free consultation on reducing taxes and or deferring all capital gains on buy-sells. And then we also offer a free trust review for creditor protection. Again, my name is Richard Rogers. This is my contact info. Again, I apologize for the beginning of the webinar. The buttons weren't showing up and I couldn't get them to show up. So I hope you learned something and thank you so much for attending today.
Well, Richard, thank you for a very informative and I think very lucrative presentation here. Those numbers are pretty darn compelling. If you are interested in a copy of today's, a PDF copy of today's webinar, reach out to us at sales@strategicsource.com or text 612-386-3898. We will be adding this webinar to the library on Strategic Source's website. And so we can make that available there. Again, Richard, thank you so much for your information today, and folks in the audience. I'd really encourage you to reach out to these folks and take them up on their free offer of consultation. Thanks very much, Richard.
Thank you.
Thanks everyone for attending today. A copy of this webinar will be available after today. So we appreciate your time and we look forward to you joining us on future webinars with Strategic Source. Thanks everyone and have a great rest of the week.